me 20 dwarves. 20 dwarves. All right. Hey, good morning, everybody. It's Tuesday, the 19th of July, 2016. Quick look around the world. S&P 500 futures are down. Euro stocks are down. Gold is stable, and not gold, sorry. Oil is stable and trying to head up. Yield on the 10-year T-note, 1 point changed. DAX is down 1%. FTSE's down 0.25%. Hang Seng in Hong Kong is down over 0.5%. The USD yen hasn't changed much at all. And France down about 1%. So Hey. Let me remind you that trading Forex is risky, not appropriate for everyone, necessarily indicative of future results. But please always stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. My name is Wayne McDonell. I'm the Chief FX Market Strategist for TradersWay. We're a broker. You can set up your account as an ECN or a fixed spread or a variable spread. Either way, we execute your trades quickly. And the fees are very, very reasonable, and our execution just wicked awesome. So give us a test. Hey, we do these strategy sessions every morning, 7:30 a.m. New York time, which is approximately London lunch. You're at Forex.Today today. Today you're at Forex.Today. If you're watching a video, why don't you come by Forex.Today? Register. Sessions are absolutely free, live and in real time. If you're watching a video, however, leave a comment. Would you do that? Don't be a lurker. Hey, Ben read the RBA minutes. Right on. Actually, they were quite interesting, I thought. Good job, Ben. Every Friday, I'm at fxstreet.com, where I'm also Forex Speaker of the Year. This year. Yeah. Cool. Going back to this, why don't you go to TradersWay.com, open up an account, take you less than a minute, give us a try, huh? Just out of loyalty or respect, you should do it, huh? All right, so lots going on in the world today. Skip. Although, check this out. Korean PPI, 23rd month of decline in a row. Wow. Isn't that amazing? Oh, Sean read the BOE's page. That's cool. I just closed it, mine, 5 minutes ago. Cool. Another thing to note, the yuan is still being weakened. China is weakening their currency. They've been doing it most of the summer. It's just weaker and 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 weaker. So anyways, now we're at the weakest point now since October 2010. The funny thing is, we did talk about that. I was pointing out yuan, you know, over the course of maybe 3 weeks, every day we talk about it. And I was set to weaken, and now I see on Trade the News that they point that out. Like now it's gone, as weak as it's been in 6 years. Wow, really? So that's going to give fuel to the fire for Japan. Yeah, cool. The RBNZ announced today some new property investment tax thingamabur is going to maybe be changed. Market didn't like that. Kiwi bad. Kiwi very bad. So, Marina, are you long pound Kiwi? Yeah, there you go. But pound is probably not the best thing to be on right now, but I guess anything better than Kiwi. Suggest any good points of reference for reading. Problems such as varied. What? What kind of reading? Can you be more? Yeah, yeah. I get that, Marina. RBA released its 80 minutes. Yeah. Largely reiterating its prior assertions. Yep. The central bank did add that Brexit had a small impact on the Aussie economy. Right? China's GDP is falling further. Australian inflation would remain low. All right. What does that mean? Well, interest rates coming down. Well, they didn't really say that, but they certainly said interest rates not going up for a while. Hey, Robin. Robin and stealing pips? Yeah. Welcome. Robin and stealing pips from hedge fund managers. Okay, Sean says, I guess there's it's technically not my book. Have you read Wiley Publishing's book that has my name on it? I mean, that's just a basic one to start with. Like that covers technical and fundamental analysis and covers some, my formula for personal growth as a trader. Things like keeping trade journals and reviewing them and identifying your strengths and weaknesses. Specific words. Yeah, and it's not a shameless plug because I think, you're not. I think maybe if you buy it, maybe $1 will come my way. I'm not sure. Maybe $2. Woo! Yeah, so I'm going to sell my soul for dollars, right? Yeah. So, anyways, but I did write it. So, all right. What's going on in Europe? UK CPI beat. Yay! 0.5 versus 0.4. Wow, was that amazing? Yeah, nothing happened. Yeah, so the pound continued to fall. Even though that's good news and inflation going up, the pound would react positively to that. But why did the pound come down anyways? Yeah, right. You probably get it used on eBay or something. How come it still went down? That's good news, guys. UK CPI beat. Inflation is higher than expected. Look at core CPI, 1.4. Oh my God. Target 2. They're going in the right direction. Why didn't the pound get strong? Peter's perfectly got it. Absolutely perfect, Peter. Because they're gonna cut anyways. Things we were talking about recently is that when you trade the news, and a lot of people, good news is bad news, and sometimes bad news is good news. People get really messed up with this. In this case, this is good news, but it's not. But it's bad news. It's not really bad news either. It's just nothing. The reason for it is you need to look at the data, assess that it's good or bad, and then ask yourself, how will, if at all, this impact central banking policy? And, well, according to what Mark Carney said just a few weeks ago, he said that the Bank of England will probably have to ease this summer. Then the July meeting comes by, the annual meeting, the perfect meeting to do a change, and they didn't change. So that means it has to be August, or he's just a lying pig dog, right? So assuming that he's not a lying pig dog, they're gonna cut in August. So like, who cares if inflation numbers were a little bit better than expected? It doesn't matter. He's going to cut. And that, I think, proves a very interesting point, right? It's not the economic data, it's the interpretation of the economic data will have on the central bank's policy. Because the policy is still to weaken, the pound is going to weaken, even on good news. So the good news wasn't good enough. Now, if it came out 2.3, which is like impossible, that would kill that, the previously discussed easing that the Bank of England would have to do. I mean, that's just not going to happen. So anyways, so the numbers were good, results were bad, and that would be expected. Isn't that interesting? Yeah. Yeah, Miles said Carney could still be put in the minority again. Wouldn't that be an interesting situation where you go and hire a foreigner to central bank and then you don't listen to him? You don't take his advice. Well, what's the point of that? Right? Oh, Robin, you're gonna be in South Africa? Oh my God, it's gonna be awesome. Yeah, it's only gonna take me 34 hours to get there. Yeah, not including commute time, of course. But yeah, I'm going to go on the double decker of the Virgin Atlantic. Yeah, look at me! I want the double decker. Oh my God, it's going to be awesome. So what else going on? PPI, what have housing price index 8.1 year over year. Hong Kong unemployment rate, wow, 3.4, huh? But still, no big moves there. And Zoo is still disappointing. All right, so whatever. All right, I mean, what do? You sell the euro. Well, both the monthly and the weekly central pivots held, so I imagine you dumped that already. But whatever. And then today, yeah, we got some housing starts and permits, and I don't think that's a big deal. So it'll be nice, whatever the market wants it to do, that's going to be what it's going to do. Right? Just nothing's going to mess it up, which is pretty cool. So, anyways, that's where we are. Nick says it took 72 hours from Seattle. Yeah, other than 34 is nothing, huh? Where did you take the train? That'd be great, huh? I took the train to South Africa. So yeah, I'm looking forward to that. Life is good, great is great. All right, so let's do some technicals, yo. There's the trend here right now is risk off. You can see, the big moves coming off of some of these commodity. We know RBA wasn't bullish. Or the bottom of the day. There's a little bit of hope that comes back the other way. Let me check something first, though. Life is beautiful. Oh, you gotta give what you got. You're gonna get what you give. Boop boop boo boop boop boo boop boop boo. Okay. So how are you going to play it? Well, on these smaller time frames, meaning like 15-minute, hourly, and that kind of stuff, and below, let me use my card tool. We're in a scenario like that, right? And on this time frame, this drop to the 100% line, so that's 100% Fibonacci retracement from there. Okay. In that situation, you look at the left shoulder to identify that, and so you'd probably think somewhere in here. Okay. And then you look at things like psychological levels and all that kind of stuff, and there's stuff in there. You can throw in the pivots and the fibs, and you come up with potential resistance. And really what happens is you move sideways. Okay? Whether it's up to be a head and shoulders pattern or whatever, it doesn't matter, but it always, the logic, the way that you work this is that the 100% retracement from the top to the bottom, based on this bottom, that puts you in the consolidating mode. The top of the consolidation should be here, so you're guessing about here, and your thought process is it will move sideways until it stops moving sideways. All right, you are now in a range-bound type strategy. You don't really know where it's going to break. You're going to assume it's going to break to the downside because whatever dropped it will probably drop it again, but it doesn't always happen that way. But you probably should always play it as if it's consolidating. Okay? And then the next part of it is whether it breaks to the upside or breaks to the downside, you're waiting for the break. So in this case, it broke here, but it could have literally done this. Either way, the next part of the strategy is to trade the dip or the rally. Okay? That's what you would expect. That's what you'd be looking for. And that's how, now that's a breakout strategy. So you go from a trending strategy, higher high, higher low, higher high, 100% retracement, consolidation, right? And then breakout, pullback, trade. Or break, pullback, trade. And that should lead to a new trend, either trend up or trend down. Okay, so just a review of technical analysis. On these smaller time frames, you would look at it like this and say, keep selling rallies until it makes a higher high. Okay? And then if it does make a higher high, right? Or more importantly, it comes up, let's say here, and then starts to fall, you consolidate off of this bottom. Okay? With the potential of it breaking to the upside. Does that make sense? So in this smaller time frame, you have a down and up, let's say a down, and then if it, the next possibility is probably like that, inverse head and shoulders. Hess says you wouldn't trade the range? No, you totally could. That's what a range what range trading is, right? Buy at the bottom, sell at the top. Okay. And one would assume too that it's probably, one would assume, but it's not always, but one would assume it would break to the downside because of this. Okay. Okay. But it doesn't have to. Sometimes it will come up and, and all that kind of stuff. And you never know when it comes down here, if it's going to go up and do another turn. And sometimes it does this, where you just, it consolidates even more ranges inside of ranges. And sometimes you can just get yourself into a big stalled out market. And you say, wow, maybe I overtraded this. But yeah, you totally could. So yeah, you know, what I've experienced, we have discussed it months ago and weeks ago and years ago. Um, and so maybe we can talk about seasonality, where I have seen very often in the past, like June and July rallies in the yens, and have been frustrated because they do stuff like this. Now it's usually not that much, but Brexit really messed things up. But often you can get like a July rally and a July crash, so to speak. We might, so in the back of my mind, I could see us back at 76 and 75, even though we're at 80. Okay. And do you think 80 is a psychological level that is predictably important? Yeah. Like, once again, if you were trading this, like, why would you just ignore all the 81? I mean, it's so straightforward, right? Like, I just don't understand it. If you're trading this, why you wouldn't see this? Like, how could you not if you looked, right? So I think the bigger thing is, whether you're trading this or something else, um, you have to remind yourself that you need to be doing the work so that you can see stuff like this, right? So I would take that as a reminder, and what really is training or drills, like if you're in the military and they're running drills over and over again. It's not like a critique of how good or how bad you are, but these are like the fundamental uh, methods of trading properly in this case, right? Like even if you've won Grand Slam medals for tennis, you still warm up in the morning, right? And hit some forehands and some backhands, and I mean the basic ground strokes, right? And your grip has to be properly, right? So yeah, I suppose. But you certainly could back out on a 4 hour and just say, I mean, look how I did this, probably months ago. But you're like, oh, all right, well, this was important here, and it was important here, and important here. You drag it across, you're like, oh my God, that was the top of Brexit. And yeah, maybe it'll be resistance again for the seventh or eighth time, right? Yeah, well, yeah, maybe. Could be, right? And then you say, what other levels could possibly be important? And you're like, well, maybe this level here, right? 77, basically. Okay. And what about we were just talking about? It's a pretty big pullback, right? So I'm wondering on the smaller time frame, if we get one of these, and then if we're down here, should I consider buying? Okay. Okay, right? That's all. The most likely one's got it like this. What do you think? And then someone else probably has it like this. And I'm telling you, I'm sure we discussed this even last year. Like literally months and months. So it's you know, not cliche, but more like part of the plan, if you will. That often there's a rally in summer and it comes back down in August, and then and then it goes up. But usually it waits for you to be so exhausted that you like. I can think it was either last year, or the year before, or the year before that. And it's all the same. Break even, and a week later I'm out at break even. That doesn't feel good when when I'm like, man, I could have just taken profit. But how do you know? And my plan was to be long forever, and then of course, in August it does this, right? In September and October. So you just got to stick with it. And if you bought it here because it was support, you move your stop, move the risk, comes back, knocks you out. But you got to keep buying, right? When you're supposed to. And that's the hardest thing because you kind of want to give up. So you have to remind yourself that these moves can happen, and you need to be patient enough to wait for the next setup. And that's, when we talk about patience and discipline, everyone's like, yeah, patience, discipline, got it, yeah, that good. Yeah, patience, discipline. Yeah, that's really good. Yeah, you got to have patience, discipline. Got it, yeah. Well, sometimes the patience and discipline is hard. Right? And that's where you're like, well, right. And Peter talks about the hedging strategy. Now, did that conversation spark anybody's interest? Is that something that you think, over the last 4 hours? You're like, maybe that is something that I would to do. That type of trading. Are you getting that type of information from other sources? And it's okay, you can tell me. You don't have to tell me I'm special. I really don't know, so do I really ask you? Do other people? So Michael says yes. Okay, cool. Run, come on. But oh well, thank you. Namaste. Michael says yes. Okay, that's cool. And Michael, is it any different from what I was suggesting? For example, having a portfolio. Well, no. I think a carry trade, like having a balanced portfolio that's hedged, second one by a second hedged account. Yeah, that's our time? Yeah, okay. Is it that they're okay? So is that their thing? Is that the thing that they go out and sell DVDs and books and stuff about? Like more, yeah. No. All right. Cool. No. Yeah. Okay. Good. Right on. So you should look into it or ask me more questions and stuff like that. But this is the time of year that you start building these portfolios. Okay? And I've always prepared people for that. So like over the next 6 weeks, I'd like to see the yen get strong again, so I can tell it. But Like if you want to look at Kiwi, which was one of the things we talked about yesterday, Kiwi yen, you know, you got to start for some of these things, right? Let me get rid of this. Let me zoom in. What's basics? Now, again, I prepared you to long here. How does that feel now after we did the 1, 2, 3 hammock stuff? 1, 2, 3, you know, the double bottom, higher low, hammock. I mean, this was just a week and a half ago. Now it's feeling pretty good, right? Sally, it's just when people are out of positions because they're on vacation, and then they have to come back to the market in September, all right? And they got to get back into their positions. It's just seasonality. Okay. So, guys, that's basic technical analysis here, isn't it? Sure, past performance does not predict future results, right? We all know that. But isn't that what technical analysis is using past performance to predict future results? I know it's a little confusing. I know the government's a little confusing. Yeah. Well, Michael, like just for thought, there have been times where I've had over 100 trades open, and literally 98 and 99% of my margin available for more trades. The reason it wasn't 100% is because that particular day that I'm remembering, I had placed 2 trades and they were losing. But I remember I had 98% available margin. I'm like, oh, right, awesome. I can get a couple more trades in. So it just shows that it is possible. Okay. So anyways, guys, this is your Kiwi, and this could be an interesting area if you want to be a bull on it. Okay. No, Miles, it doesn't matter how much you have. If you have 1,000 trades open, if they're all profitable, you have 100% margin. Well, why would you have 100 losing trades open? Unless you're just completely mentally deranged. Yeah. Well, your stops can't be at break even unless they're profitable, right? So, I don't know, I'm just driving home the point. You don't want to have 100 losing trades open. But I make $2 a day on interest. Yeah, but you're losing $20,000 a day in pips, right? No, well, no. Where your stop is, again, is irrelevant. My stops could still be minus 100. That doesn't change your available margin. What changes your available margin is how much your portfolio is worth. Okay? So if all your trades were 100 pips above your entry, all your trades are profitable, plus now you have the profit that you're collecting mark to market in your account. So now you have more money. You started with $100,000, now you have $130,000. Now your trades are open, but we're mark to market. So maybe I don't have any, it's irrelevant, right? That's just risk management, but it's not going to affect my available margin. But if I'm up profit because my portfolio generally is profitable, then my available margin is going to be, well, I have all my money that I risked, plus I have 30% more money. So yeah, but yeah, you would think you would have at least a small profit locked in on those. Yeah, but it's not, that wouldn't affect your available margin. Your available margin is affected by how profitable your positions are. And I think at that time it wasn't that all the trades were profitable. Let's say 30% of my trades were, not quite profitable, or, small. Right? So yeah, so if your account is profitable, you still have available margin. So anyways, so in your mind, the way I try to teach myself is to say, one, and when that's profitable and you've moved your stop, go find another trade, right? Or like I say in my book, you have 3 seconds to cheer about the glorious trade you've made. Then you got, so whatever. So here we are, and that might be interesting to you if you're a bull. Okay? Now, were you watching when we were at 70? Or sorry, 74? Seems like that's something that you could have had your eyeballs on, right? So Aussie and Kiwi are commodity currencies. P500 goes up today. Those commodities will go up with them, right? So the question is, will the S&P 500 go up today? Well, maybe off 21. Do 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 do. So that the S&P 500 goes up today? Off the 4-hour 21? It's plausible. The thing is, do you have a plan? That changes everything, right? Now, if you're a bear, you're happily going to sell, right? Because you're in the role reversal. So you got to pick your lines, right? You got to pick your team. And maybe you sell because you don't expect earnings today to be great. Okay, that's fine. So if you're a bear, kind of the thing you're looking for here. If you're a bull, however, you're looking at the smaller time frames, and you're going to do this almost like a breakout, pullback, extension, pullback, so on and so forth. What? Sachs beat today. Okay. So play it like you see it. And to see it, it kind of denotes that you have to look at it. So take a look at it, right? So again, if the stock market's going up, you usually have risk on, like sell the Japanese yen, buy commodities, for example. Okay. Do you remember talking about copper yesterday? It was weak, but it's sitting on the week for pivot. Huge, huge rally in copper. Yep. Did you see zinc today? And so I hope you guys take the opportunity to either start your own trading journal or start your own community, or at least give feedback. Have chosen to do that. But the power of Forex.Today is for you to leave your own analysis. Ona's got some charts going. Yeah, good job, Ona. Boom. Thank you. Yeah, see that was really difficult, right? That took a lot of time. Well, it took this, it took Ona a lot of time to write this down for you. $15-minute double bottom higher high. Yeah, I can see that. Consolidation. Breakout, pull back. This be the higher time frame. No, lower time frame. All right. Yeah, yeah, I can see that. These are like the fib areas to buy here, here, or here, without a turn. Yeah, I like that. Thanks. Oops. I hope you catch the pullback. Boom. Right? This is like an education to go through and see what other people's trade plans look like. And then think about, did you see that? Do you like it? Is that the type of trading you like to do? Yeah, see, Daniel's charts are always so clear. I think Daniel's been trading now for what, 7 years? 8 years? Beautiful. So he wants to buy this off the daily pivot. He wants to long it in a downtrend, but it is a Kiwi yen. That's what we were just talking about. See? Yeah, he's got the little Stokes kicker, looking for option up to the 21, pull back and break. I think he got that. Where's his number? 74.20. Oh, that's perfect. Look at the buy zone. He's even got it right at the bottom. That is a perfect trade. I'm going to like that. I think you caught the perfect entry on this. Great job. Boom. Yeah, nice trade. Sweet. Sweet. Yeah. Good job. So anyways, how long does that take me? What was that? 4 minutes to go through 3 different trade plans, think about what I would see and what I like and what I don't like, and to leave a little feedback or at least a thumbs up to say, hey, thank you for posting this. I'm going to, I appreciate it. It takes very little. Every time you give it a like, the author is sent an email. Did you know that? Just to say, hey, I appreciate. Yeah, hey, Robin, just feel free to ask questions. That's why we're here. All right, so whole point. So anyways, watch the S&P 500, and then how about this yen? It's looking beautiful, isn't it? It might be slowing down, but it's a freight train north. Wonder for when we'll get a breakout. Now looking on the smaller time frame, it was fairly quiet today. But buying into these dips and do 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 do. Loaded like a freight train, lying like you never came, feeling like a space brain one more time tonight. All right, Coolios. So is anybody going to make some posts before the New York Open on Forex.Today? Anybody going to be brave, share their thoughts? Because usually, I think the best thing to do is like right before the London Open or right before the New York Open, you should put down what your thoughts are, what kind of trades you're looking for. You don't have to be right or wrong, but you can share with like, what are you looking for? What's on your radar, right? Anybody going to volunteer? I mean, come on. If you're a trader, you need to have confidence. You need to build confidence. You cannot be a successful trader if you lack confidence. You need to manifest your thoughts and make a commitment. Because every time you pull the trigger as a trader, it's a commitment. You're committing money. In this situation, you're committing a little bit of time and thought. It's your time to build confidence. Ba bam bam. Lots of consolidation here on oil. Just kind of stuck. So there's another reason why oil could come down. I was reading about how actually, let me ask you, who buys crude oil? Because we track oil prices, right? But it's crude oil. And there's only one group that buys crude oil. Don't buy crude oil. Your neighbors don't buy crude oil. If your income goes up, you don't have a marginal propensity to increase expenditures on crude oil. Refineries buy crude oil. And what do they do with it? They turn it into product, like gasoline. Well, they've made some mistakes. You know, and it goes back to 2 years ago, I think it was. Unusually warm winter. And what the refineries decided to do, and remember, they're not in collusion, so they just all kind of independently made the same thing, like, hey, there's very little demand for heating oil. Guess we'll make some gasoline. And we're at this situation right now where it's a gasoline issue. And right now. And we're at the point where there's so much gasoline that there's no need for more. So you know how we track inventories, like actually in the inventories. Gasoline is way up there too. And what happens if they just stop using gasoline? So yes, crude demand. So you can trend in supply and demand for oil. And as you know, oil producers are going to produce oil no matter what, right? And we're also watching oil rigs come online. What was it? 7 rigs just last week. So like we're gonna have oil. So we're producing oil. We're producing more and more oil week over week over week. We're producing more and more oil, or the capacity. This we're adding to capacity to for oil, but yet on the short run, let's say over the next few months, we just won't need any more oil. Like the refineries will slow down their demand for oil. Yet we'll keep producing more capacity and more oil and put it into storage. So yeah, there could be another wave down back to the 30s. And that would bring my yen-yens down. Well, yes, we are bears, Michael. We've been bears for a long time. But look at my notes here. Back in April, we said it would go up to 50 and then drop. And then we consolidated around there until actually, then we had our lower low, lower high scenario, which then I've outlined going back from the retest of 50 down to 41. And I get that from distance of the peak of the crown to the neckline, juxtaposed to the right shoulder. Okay, so but remember, that's just technical analysis, which is nothing. It means gobbledygook. What really matters is supply and demand. So what I'm suggesting now, like, we've been doing things like watching oil inventories, and I understand the seasonality and the historical patterns of oil inventories, which is a normal thing for us to talk about, in particular on Wednesdays. And then more recently, I've introduced rig counts to your analysis, right? So we're looking at global macroeconomics, We're looking on demand side for energy, right? Now we're looking at supply side. Oil inventory is now actually the tools used for production, right? And lastly, now I'm saying, you could look at it like a crack spread analysis of, you take oil and you crack it into a derivative like gasoline. And if there's so much gasoline in the world right now that there's no need to produce any more gasoline, then that in turn would lower demand for the underlying commodity, which is oil. And we know on the supply side analysis that we're adding to the capacity for supply, and therefore supply actually start to rise, which would then lower the price of oil. Because demand is fairly constant low, supply is too high, and we're adding to the capacity for more supply, yet demand is stable, so prices should fall. And I hope that makes sense. Right on, Alan. That sounds great. Up 250 pips already? Well, don't worry, you'll get better. Miles said, how is oil correlated to yens? Okay, great. Let's talk about that for a second. Let me zoom in just to change the colors. Okay, great. If oil goes up, demand for oil or energy, just in general, energy is up. Increase in demand of energy is very often tied to an increase in economic activity. And it is a global product. So maybe it's an increase in economic activity in the United States or in Europe or in China or throughout the Asian region, or maybe Latin America, so on and so forth. And I don't know anything about Africa. Right. I don't know about anything about Africa. That's not true. That's not true. But if there's economic expansion, an increase in activity, like let's say travel, or the number of homes that either need heating or electricity, the capacity utilization of factories, all these things, travel and everything that is associated with more economic activity usually needs more energy. Now, some economies are more energy intensive than others. The United States is a little more economically efficient than, Timbuktu. Very, very energy intensive economy. So it's not a one-to-one thing, but increase in demand for energy is usually associated with an increased demand in macroeconomics, let's say. Okay? And that also means money is moving around for investment opportunities. If Australia their economy starts improving again, we may want to invest into some companies and some of the opportunities. Like maybe China goes in and says, all right, well, we need to invest more money in iron ore production and other capacities, or coal production capacities, and maybe they want to build some ports and increase various aspects of their supply chain management to get those natural resources back to China. Well, that means money is going to leave China, get converted into Australian dollars, and then they would build these ports and increase the investment into the production of iron ore and coal. Okay, which means now they need Australian dollars, and demand for for that is going to be high. Now, when you are leveraging years, so an increase in oil demand is an increase in energy demand. An increase in energy demand could be increase in economic output. Now, money flow of, okay, which would then increase demand for the currencies of those investment opportunities, and which could be leveraged through the Japanese yen, which would decrease the supply of available Australian dollars, but increase the supply of Japanese yen as that floods into the market, as investors take the borrowed Japanese yen and invest either into Australia or New Zealand or wherever. Okay, so increase in money supply of Japanese yen, decrease in money supply of those other investment currencies, and you have a weak yen and a strong everything else. So Japanese yen is only taken as a funding currency, well, over the last 20. But you could look at Swiss. So think of a billionaire oil sheik somewhere. When do they stuff their money into a Swiss bank account? Well, when they're afraid. And then when do they take a Swiss bank account to either spend or invest? Well, when times are good. You see what I mean? Just think of it that way, where suddenly, who was it? One of the princes of Saudi Arabia. I remember watching an interview with him 6 years ago, and he had billions and billions and billions and billions of dollars to invest. I asked him where he was going to put the money, and he said, "Well, I can't buy money in the United States or you know, the entire electrical companies for countries, for example." And he's like, "Yeah, I can go into Ghana and buy their entire electrical infrastructure for 35 cents on the dollar and just own it for the whole country. And over the course of the next 100 years, make my money 1,000 times over." So in that case, he's going to take the money out of his Swiss bank account, send it to Africa, and buy things at pennies on the dollar. Interesting stuff, huh? And of course, you can leverage up. You can leverage up on free money from Japan. Okay? Yeah. It's sort of now like companies in the United States are borrowing money for free and then buy. A company borrows $100 million for. Wow, is anybody here? My mic break? Oh, all right. Did you lose sound? Oh, okay. Yeah, I said, oh, really? There's interruptions and stuff on and off. Oh, okay. I asked, If a company decides to borrow $100 million for free, because interest rates right now are near free, and they decide to take the $100 million and then purchase their own stock. So they go and buy $100 million of their stock. What happens to the price of stock? Prices go up. What happens to their earnings per share? Up. Because there's less shares on the market. Because once a company buys those shares, it actually it's not considered a public share anymore. You know, it's not part of shares outstanding. So earnings per share goes up because let's say you earn the same amount of money as you did last quarter, but this quarter there's less shares. So earnings per share have gone up, which then is what? Entices people that are not that smart with their analysis to buy more because CNBC and Bloomberg says, oh, wow, look at XYZ company. Their earnings per share are up 25% quarter over quarter. Well, yeah, because they borrowed money. Now the company has debt. They borrowed money, bought out their shares, took them off the market, and artificially jacked up the earnings per share. But the company has actually got $100 million worth of debt now. But the company's worth more per share. Woohoo! But what that does is gets people to go in and buy some more. They're like, wow, did you see XYZ company? EPS is 25%. Q over Q. Boom. Share prices go up even more. So the company is strapped with $100 million worth of debt, but what does the CEO benefit? Yeah. Sell some of those shares, right? Boom, boom, boom. Isn't that funny? So that's what's happening. Free money. That's what happens when you get free money. So eventually money is not supposed to be free. You understand? Weird like that happening. Biggest loser right now is Kiwi Yen, but I think that's going to go up, yo. Aussie dollar way down 1.4%. Crushed, huh? Yeah, euro dollar's come down nicely. We have a monthly pivot point coming up somewhere on that sucker. Uh-huh. You are the one. So it's really just falling into my evil plan. Right? You see that? Yeah, if you're going to buy gold, falling right into your plan. Look at this. Up, down, should go up. All right, so you want it this way. All right, fine. Same deal, dude. So anyways, it down to the roll reversal and is holding them on the weekly M2. So this should go up to 1382, which is really interesting. I shorted 1382. But it was... There it is. This is my old short. I remember that one. Sell it at 1382. Sell, sell, sell. And I said, back here at 1382, I said the target was somewhere between 1100 and 1000. And I said the only reason that would hold is because it's psychological. And that some people that are holding physical gold are going to use the futures market to protect 1050. I'm like, oh, somewhere between 1100 and 1000. The closer you get to 1000, the more likely it's going to go up. It came down to 1050 and went up, which is really just funny. So here we are back at 1382, which ain't funny, but what changed this? Why did we go from 1,000 to 1,000 and almost 50% back, 40% back? What made this 40% rally off the bottom, if you will, of this range? Okay. Another reason the stock market's going up, what does the 10-year T-note pay? If you bought a 10-year T-note, what does it pay you in yield? %1.6%. But that's a 10-year investment. How about a 2-year? Let's Google that. 2-year treasury notes US. According, we'll do CNBC. I usually do Bloomberg, but let's be fair and balanced. Hang on. Okay, 2 years. If you invest your money for 2 years in the United States government, they'll give you almost 0.7%. Okay? 0.7. So let me do another Google search here. What is the SP 500? Did you mean average dividend S&P 500? Yes. S&P 500 do 2%. Based on 12-month dividends, March 2016, as of March through, yeah, okay. There you go. So where are you going to stuff your money? If you're a fund manager, you're very, very interested in buying stocks that pay dividends. And then I think you're taxed differently on dividends, right? Versus capital gains. I think the effective yield is even higher, is what I'm trying to say. I think you're clearing even more than that. And then, of course, you could let's say many of the stocks in the S&P 500 are not paying dividends, right? So if you built a dividend, do they even have one? U.S. dividend stock portfolio. Let's see what comes up there. Warren Buffett's top 10 dividend paying stocks. Build a dividend portfolio that grows, but that's not going to be one. My U.S. 2016. All right, I don't know who this is, but let's just see what he's done. My principal goal for this portfolio, blah, blah, blah. Here's what he's holding. There's international select. There's a spider ETF dividend. All right, this doesn't say anything. dividends. How about you? Is there maybe a ETF? Let's see. Not EFT. ETF. Oops. ETF. Wisdom tree. Fidelity. Well, I can get information if I sign up for a newsletter. No, thank you. All right. 50. Here's one. 57 different portfolios you can buy into. Let me close this ad. Okay. All right. So again, if you invest 2 years into if you buy a 2-year treasury note, you earn less than 0.75%, right? 0.69, whatever it was. These are ETFs that build portfolios for you based on dividends, right? And anyone can buy these things. Wisdom Tree is a big one, right? Check it out. Right? Typically, your higher paying ones are associated with more risk. Invesco is a company here in Atlanta. Look at that, 9.73. Guggenheim S&P 500 Global Dividend Opportunities, which just says international junk bonds, but whatever, right? But amazing stuff, though. So one of the things I'm going to say is that it's another reason why the stock market's going up, because you could do things like borrow money for free and buy your own stock if you're a CEO, or you're a billionaire fund manager and you're like, why the heck would I buy a 2-year T-note, a 2-year note that pays less than 1% when you could just buy some ETFs and collect dividends, which means that drives up stock prices. You see what I mean? Because you're buying stock to earn income. So that's how you used to value a stock, where you would look at the dividend payments, count that as income, and do discounted cash flows into the future. Right? That the value of a stock is the discounted value of all forward income payments, dividend payments, right? So you could do that through dividends. Do it through just simply buying bonds. But okay. Or, as I talked about yesterday, you could do that in Forex. Use Japanese yen, leverage up, collect interest payments, and if you're even lucky, you make pips along the way that are worth way more than even the interest payments. You're welcome. Oh man, look at the time. I didn't even realize the time. It's slow. I apologize. I've gone way over time again. Interest rates are little, yeah, but the thing is, if you're leveraged, it's better, right? So like the 2-year note only pays 0.7. That's nothing. But if you were leveraged 10 to 1, now it pays 7%, and that's pretty good. What does that mean? Every 12 years you double the account? No, every 10 years you double the account. Is that right? It's even less than that. Oh, if you're compound, but you wouldn't be compound. But anyways, yeah, so that's good money. So anyways, thank you very much for being on my team and being here every day. I look forward to my time with you. So peace on earth. May the pips be with you. May your profit above average. Enjoy the New York session. And I'll see you again tomorrow. I'd like to see your trading ideas. I'd like to see your trading ideas. Will you take the time and post what you're looking at for the New York Open? What are you eyeballing right now? Will you document that? Just one currency pair that you think might move in the next hour and a half? Will you do that? Yeah, Sean, that's around. It's called strategic and tactical Forex trading. You can just Google, Wayne Awesome McDonell Forex. I wonder if that's true. Wayne Awesome McDonell Amazing Forex book. Yeah, that'll do it. What is this? Strategic and Forex Trading, Eastern Forex Expo 2009? They have a PDF? What the heck is that? Maybe you can get my book for free. Doesn't seem to be anything there. Oh, wait. What did they put up here? Oh my God. It's loading because it's so big. Did the Middle Eastern Forex Expo kind of PDF and distribute it on the internet? No. Wow. Oh, it's just a presentation? Yeah. From 2009. I wonder what I said in 2009. It's taking a sweet time loading. All right, well, I'll have to look at that someday. So anyways, peace on earth. May the pips be with you. May our profits be above average. And I'll see you tomorrow. Yeah, it's taking a long time, Kenny. I'm like, but I did do one, I think, in the Middle East on how to run a hedge fund or hedge fund strategies. That's right. I did one in about hedge fund strategies in the Middle East. (2009). That must have been when I stayed in the what was it? Al Arab, the Burj Al Arab. Has anyone seen that video where I seen the world's only was it 6-star hotel? Has anyone seen that video? Yeah. How funny is that, huh? Oh, you want to see that? Yeah, I think it was like $7,000 a night. So it was pretty nice. I think it's here, videos. Yeah, here it is. Was that 2009? Sure enough, 2009. Yeah, that's when I was in that conference. The only 6-star hotel in the world. Find out what $7,000 a night buys you. All right, cool. Here, it's a Facebook. Oh, you went there, Sally Pop? Yeah, cool. Oh, for tea. For tea. Did you stay there? No. Where did you have tea? Like what restaurant was it? The one at ground level where they do breakfasts and stuff? I forgot to stop the recording. I'll do that now.